All right. Today is Tuesday, September 7th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And of course, I say this every night, but this one raises the bar. And here it is, in focus tonight. We're going to talk about decoding the market because we had important developments regarding the Dixie, the dollar index, and the bond market. We're also going to talk about the stagflation storm, since everybody now suddenly realizes that the economy is heading into stagflation. And lastly, my commentary regarding the flash crash in the crypto market and the implication of the legal tender adoption in the country of El Salvador. Let's start by decoding the market. In our discussions regarding the bond market mystery and why was the bond market reacting in an unusual way to the Fed's sentiment regarding tapering, starting in May and June, some Fed members started to sound the alarm regarding inflation and suggesting that tapering could happen this year. And of course, Jerome Powell kept an open mind to all of these discussions within Fed members. And of course, the Fed used a very gentle approach, using the white glove to prep the market into tapering. Unlike 2013, when yields actually spiked higher in the taper tantrum, which is, by the way, the end result of tapering, when you have the Fed buying billions and billions of dollars of bonds, a minimum of 25% of the entire supply of bonds. When the Fed eases in their purchasing program and buys less bonds, then prices of bonds will crash. Meanwhile, yields will spike up higher because we have an inverse relationship in bonds. This time around, the taper tantrum was pretty much the inverse picture of 2013 because we saw yields crashing. Meanwhile, a rally in the TLT and bond prices. And the mystery at the time was, why was the bond market reacting in this way? Because if the Fed is about to taper, the taper tantrum should push yields higher, similarly to the 2013 scenario. And in decoding the mystery, we highlighted the element of psychology in the bond market in this reaction. In essence, the bond market was sending a tantrum message to the Fed that if you taper now, it's too early, and you're gonna kill the recovery story in the economy, because yields are a pulse for the prospects of economic growth in the future. When yields spike up higher and we have what it's called the steep yield curve, where the long end of the bond market, the yield curve, is higher than the short end in a steep fashion, this is an indicator of a healthy economic prospects. The expectations are for better growth opportunities in the economy in the future. But when we have inverse yield curve, or the short end of the yield curve yielding higher than the long end, then the picture of the economic outlook is actually disastrous. And when the yield curve inverses, it is always a predictor for recessions. And this is exactly what the bond market was forming in the yield curve starting back in May. And therefore, regardless of the inflation data we've been receiving, whether it is the PPI, the core chiller index, the core PCE, all the highest numbers on record or since the stagflation of the 1970s, yet yields continued to trade down. Yet somehow, every time we got bad news, economic-wise, prompting the Fed to delay tapering, yields would spike up higher. So there is an element in the bond market that says if the Fed doesn't taper, yields will spike up higher. We have no reason to hold bonds and bid them higher if the Fed is going to allow inflation to rise a little higher and allow the economic recovery and growth story to continue. Yet mind you, all of us, including the bond market, realizes that the end result of tapering will push yields higher because the Fed will buy less. So we have two scenarios here in which yields spike up higher. Scenario number one, the market's expectations of a delayed tapering. Scenario number two is the market's expectations that the Fed will actually taper. No joking this time around. So how do you distinguish from the two scenarios? How do you know that the bond market reaction today was in support of scenario one, meaning no tapering, or scenario number two, meaning tapering? Because we are at a point right now where we have gotten to the super cycle. Remember the super cycle? We got it now in bond yields, and bond yields will continue to spike up higher due to this super cycle. Why? We have two different scenarios. Each of them produces the same result of yields pushing their way higher, whether the Fed delays tapering or whether the Fed actually tapers. And this is how you distinguish from the two. When we look at the heat map, for example, if the bond market reaction today was due to scenario number 1, where the Fed is not going to taper, then the expectations are the Fed will allow inflation and growth to continue. This should be good for industrials, metals, oil, commodities, but this is not what we saw today. We saw a down day, a severe one, in industrials, the cyclicals, energy, materials. What does that say? It says that the market's reaction today, specifically in the bond market where yields are spiking up higher, is due to scenario number 2, which is the market's expectations finally submitting that the Fed will actually taper. And there is no escape right now. There is no point of throwing a tantrum. The tantrum has been already thrown. The Fed listened and continued to delay, but now we have the inflation storm, the inflation monster, evolving into a stagflationary monster. And the Fed will have no choice. It will be forced to taper. And that is, by the way, supported by the move in the US dollar today. The dollar is spiking up higher. Now, before I move on, there are also technicals supporting the rise in the 10-year yield. For example, when we look at the line chart here, this is a daily chart, we have a cup and handle formation, but this cup and handle is within a cup and handle. This is the Christopher Nolan pattern. So you have a cup and handle within a cup and handle. And if we zoom out to a weekly chart, you can see that we have a cup and handle within a cup and handle within a cup and handle. This is the Christopher Nolan pattern. There is a rule in the market that says don't fight the Fed, but the ultimate rule is don't fight Christopher Nolan. Yields will spike up higher because we have entered a time frame where both scenarios, taper or no taper, will support yields higher. Now, in our scenario analysis, we have discussed what happens when the dollar index and yields rise higher together. This is scenario number 1, by the way. It is bad overall, bad for oil, commodities, gold, inflationary stocks, even tech stocks. But what happened today? Pretty much everything was down with the exception of some financials and the big cap technology stocks, specifically Apple, Amazon, and Tesla. Now be careful here, because if yields and the dollar continue to rise together, the moves you're seeing in big cap technology stocks will reverse. So why did big cap technology stocks, specifically Apple and Tesla, pop higher today? We have a reliable pattern here that has been going on for days and weeks of some entity, quote unquote, that continues to pump Apple and Tesla at the beginning of the week, Mondays, Tuesdays, and then dumping right away on Friday and by the end of the week in general. And they do it via call options. For example, this is the chart of Tesla, 30 minutes. And you can see every time in the beginning of the week, Mondays and Tuesdays, we see these massive pops in the stock via call options. And then the stock dumps right away by the end of the week. This is a similar story, by the way, in the chart of Apple. This is a 30 minutes chart, and I'm highlighting the pumps at the beginning of the week.
All right, time now for you unusual activity. Pete, what are you seeing?
I got something really unusual for you, Frank. Earlier we were talking about Apple, and I talked about how everything that we are seeing option-wise, for the most part, is very, very short term. Apple, just a few minutes ago, we had a huge buyer, 130,000 of the September 10th expiring Apple 157.5 calls. They were going for about 50 cents up to about $1. Just an amazing size trade, and that is what we see oftentimes in Apple are a very, very large size upside trades. It's something that I talked about at the top of the show when we were talking about Apple and how it trades. So we're seeing that. That's pretty interesting. I think you can add that along.
So we have market manipulation going on here. What is the objective? Who knows? You got to know who's behind it to know what the objective is. But for all I know, forget about the SEC. You might have heard the story that Fed Chairman Kaplan, excuse me, not chairman. This is his dream. This is his pornographic dream to become a chairman because he's into shares. But his Fed President Kaplan of the Dallas Fed Reserve, he got caught trading stocks last year while he was pumping the market via fake money. Again, it's a crime. The man should be in jail. But will he? Of course not. And who knows who else is also trading via inside information from our public officials. We know at least that Nancy Pelosi gambles with options. She's buying options here and there while doing her job as Speaker of the House. She gets the inside information and trades based on that inside information. So for all you know, perhaps SEC Chairman Gensler is also trading stocks and options on the side. This is an unregulated jungle with no stop in sight. Next, let's talk about the stagflation storm in the global economy, because we're hearing more voices sounding the alarm, talking about stagflation and the risks associated with stagflation in the global economy. For example, we have ex-Italian Prime Minister Monti, and he is describing stagflation as the greatest threat to Europe's recovery, issuing a dire warning for the European Union about the stagflation risk. And of course, the ECB went bananas with the money printing, even exceeding the veracity of printing from the Federal Reserve here in the United States. Bloomberg says stagflation threatens to upend the global economy. And of course, we have two examples of inflation right now. These two dynamics are now evolving into stagflation because they're combined with delta. Of course, we have the two classics. We have demand pull inflation and we have supply push inflation. You combine that with COVID and all of these shutdowns of ports, etc., and you have the perfect stagflationary storm. An example for the cost push inflation is the shortage in chips, and now the global chip shortage is predicted to persist for a longer time, perhaps all the way till the end of 2020, even going on all the way in 2023. So we have a severe supply shortage here from the core and the heart of the electronics industry, which is included and essential for the automobile industry. Chips. If we have a chip shortage, then forget about producing anything. And now we have predictions that this chip shortage will prolong way beyond any expectations. What does that mean? Prices will skyrocket higher, and this is the ultimate bullet, by the way. Chips, they're involved in every industry across the board. So if chip prices are rising higher due to the shortage, then producers across the board are raising prices on us, the end customer. This is called supply push inflation. It comes from the supply chain. But we also have demand pull inflation, and this is coming out from the rise in incomes, at least for now, due to the stimmies, and that also evolved into an inflation in wages, and now this will cause even more demand pull inflation in the economy. Now, there are many schools of thought here. There is a school of thought that doesn't believe in cost push inflation. This is from legendary economist Milton Friedman. They believe that inflation is a monetary phenomenon, and supply push inflation doesn't exist at all. It is just a byproduct of demand pull inflation. And demand pull inflation in the economy is a byproduct of printing, the generosity of the monetary policy.
Recently, we've heard that the inflation currently experienced in this country won't respond to monetary restraint because it's cost-push inflation and not demand-pull. What response would you have to that analysis, if any?
It's another example of the people who produce the inflation trying to find scapegoats for their own deficiencies. Of course the inflation will respond to monetary restraint. There is no such thing as cost-push inflation, except in the form of the delayed effect of monetary inflation. If you have a monetary inflation that starts to push up prices, it tends to hit retail and wholesale prices first, the prices you and I pay. It's only later that it works its way through costs. But then costs fall behind prices, and there's a make-up period. And during that period, you have what looks like cost-push inflation. But there has never been an inflation in history that didn't respond to monetary restraint. If you look at American experience, it responded to monetary restraint. If you take that roller coaster I was telling you, on each occasion, the slowdown in the rate of inflation was preceded by a slower rate of monetary growth. And you have much more dramatic examples of that. Most dramatic example from American history of how inflation responds to monetary restraint was one that was once dug up by a student of mine when he was writing a dissertation on inflation in the Confederacy during the Civil War. And in the later parts of that war, you know, the South financed the war almost entirely by printing press money. And the rate of inflation during the Civil War in the South, I don't know, got up to something like 4 or 5% a month or more. But at one point in the later part of the war, the Northern Army overran the place in the South where they were printing money. And for 2 weeks, the printing presses couldn't operate. And lo and behold, within 2 weeks, the inflation stopped.
Now, the views of Milton Friedman could be a little outdated here, due to the pandemic, of course, because nobody would have predicted a global pandemic back in the 1970s and 1980s. The moral of the story is, this time around, we have perhaps the biggest inflation storm in history. Why do I say that? Back in the 1970s inflation, the 1970s inflation was actually a byproduct of a mistake from the Fed in the 1960s. And inflation was fluctuating up and down throughout the 70s before reaching the final stage, the stagflation stage, in the late 70s. So the evolution of inflation into stagflation took almost a decade. This time around, the evolution from inflation to stagflation is taking about a year. Why? Because this time around, we actually have not just demand pull inflation, we have supply push inflation together, creating the ultimate storm, the ultimate stagflationary storm. And of course, Jay Powell and company are absolutely clueless about this. Back in the 70s, according to Milton Friedman, we did not have cost push inflation, even though energy prices spiked up higher. In the Friedman school of thought, the rise in energy prices was a byproduct of demand pull inflation, which was a byproduct of the monetary policy of money printing. And once you do monetary tightening by raising interest rates, you will see that cost push inflation from energy prices or otherwise magically disappear. So it could be argued that back in the 60s and 70s, we had a demand pull inflation. This time around, not only we have demand pull inflation due to the generosity of the monetary policy, the quote-unquote accommodation, by the way, but we also have supply push inflation due to the pandemic. We have legitimate supply push inflation. And of course, the blame will go back into the lap of the federal government and who's in office right now, while we know all along that inflation has always been a monetary phenomenon. Why is this important, by the way? Because at the end of the day, the Biden administration will be blamed for the stagflation phenomenon and the unavoidable collapse of the economy. While you and I know, whether it is Biden or Trump or anybody else, the end result will be the same because inflation is always a monetary phenomenon. Unless the Fed behaves differently under a different administration, the end result will be the same. But who will catch the blame? Whoever is in the office. For example, in the 1960s and 70s, inflation was rising higher in the Nixon administration, in the Ford administration, and finally in the Carter administration. But who got the blame for the stagflation in the 70s? Jimmy Carter, because he was at the wrong time, at the wrong place, and the economy has already evolved into stagflation. It was unavoidable, regardless of who was in the office. So perhaps Biden's biggest political enemy is not out of the Republican Party, but actually out of the Federal Reserve. Biden's biggest political opponent is Jerome Powell. So if this moron actually renews Jerome Powell's tenure, in essence, he will be signing his own death warrant because Biden will be blamed for the fallout. Meanwhile, Jerome Powell sails away into the horizon. Nobody's going to blame him for what happened. And vice versa, by the way. Whoever comes out in the right time and the right place when the Fed is tightening the monetary policy to curb inflation, that particular president becomes the hero and takes credit for the recovery out of inflation and out of what follows, which is usually a recession. And this is exactly what happened with Ronald Reagan. The Republicans, the conservatives, regard him as a hero and as the guy who ended inflation and ended recession and Reaganomics, are responsible for the thrive in the 1980s. That's all garbage, of course. If you have one brain cell that works, you understand that. What Reagan actually did is expanding the budget deficit and initiating the era of racking in public debt like never before. So while Reagan is considered a hero and a god from an economics perspective, he had absolutely nothing to do with the recovery. Likewise, Jimmy Carter had little to do with the stagflation and the recession that followed thereafter. Because remember, inflation is always has been a monetary phenomenon. It has nothing to do with the federal government, the fiscal policy, the supply bottlenecks. All of these things are byproduct of the monetary policy, which is the core of everything. So if you want to understand what happened in the 70s and the so-called recovery in the Reagan era, you have to understand one man, and this man is Paul Volcker, legendary Fed Chairman Paul Volcker.
At 6'7", Paul Volcker was known as Tall Paul, and indeed he towered over economic policy for more than 60 years. President Jimmy Carter chose Volcker to head the Federal Reserve in 1979, when the U.S. faced runaway inflation. To bring prices under control, Volcker, never without a cigar, choked off the money supply, driving up interest rates to discourage lending and borrowing. Volcker defended the policy on the McNeil-Lehrer report in 1981.
The way you're going to get those interest rates down is by persisting in policies that will indeed continue to bring the inflation rate down. And at some point this dam is going to break and the psychology is going to change.
And sky-high interest rates, he figured, would have the desired effect, as they did, but caused deep recession and unemployment that reached nearly 11%. Home builders sent Volcker their protests scrolled on wooden planks, but Volcker stood tall.
You know, you can't deal with that problem by simply saying we're going to let inflation go ahead.
Volcker's policies may have cost Carter the 1980 election, but in a statement released today, the one-term president said, although some of his policies as Fed chairman were politically costly, they were the right thing to do. By 1983, inflation had come down dramatically, and President Ronald Reagan reappointed Volcker, a lifelong Democrat, as Fed chair. But the two soon clashed over the growing federal deficit, which Volcker feared might reignite inflation. Volcker left the Fed in 1987. His last legacy, advising President Obama after the 2008 financial crisis, pressing to restrict commercial banks from making risky investments, a controversial reform known as the Volcker Rule.
In essence, when Jimmy Carter hired Volcker to address the issue of inflation and stagflation at the time, Volcker realized that it is too late to do anything but the harsh remedy. You have two remedies to inflation. Number one, you let it take its course throughout the economy because inflation is like a tornado. Sometimes it is F3, F4, F5, but it will do destruction in the economy. It starts good with a nice breeze, a little bit of rain, and then the tornado hits and it's destruction at that point. And you have to wait and watch out for the tornado to do all of that destruction, and then it goes away. So when the Fed says it's transitory, every inflation is transitory, but it leaves the economy scarred for a long time. So what is the other remedy? Preventing the tornado from happening in the first place. You time it right, you have the nice breeze, the rain, and then you have to prevent the tornado from being born. And you do that via tightening the monetary policy. You do it gradually, one step at a time. You taper a little bit, you raise interest rates a little bit, and therefore you prevent the abrupt crash, the negative impact of tightening the monetary policy in an aggressive manner all at once. And this is exactly the risk that we have right now. If Powell and company continue to say that inflation is going to be transitory, meanwhile inflation continues to rise in an alarming fashion, then Powell, or whoever succeeds him, will have to use the Volcker approach, which is the harsh stop of the tornado. The tornado is already here. We have to bring in the big guns. The nuclear weapons to stop the tornado. The nuclear weapon is to raise interest rates dramatically. This is exactly what Volcker did, and it cost Jimmy Carter the re-election because the economy went into recession, and Jimmy Carter took the blame. And of course, when the recession was over and inflation went away, now we had plenty of room to ease the monetary policy and therefore re-stimulate the economy to grow once again. And who took the credit for all of that? Ronald Reagan. So once again, monetary policy is always responsible for inflation. It is always the core and the source of inflation rising higher. Now, you think Biden is even aware that Jerome Powell is his worst enemy right now? Of course not. And the moral of the story is we have an incompetency crisis in this country. Politicians and government officials are now concerned about their personal end of the matter. They're concerned about the political ramifications of the decisions, not whether the decisions are right or wrong. What this country needs to solve the incompetency crisis is men and women like Paul Volcker, a true maverick of his time, who did the right thing regardless of the implications on his own career and the political implications on his own party and the president leading the country at the time. He did not care at all. Wall Street hated him. Politicians hated him. But at the end of the day, he did the right thing for this country and for the global economy. And Paul Volcker is exactly the man that we need at this time when we have a crisis of incompetency in the Federal Reserve. And here we have a final thought from economist Mohamed El-Arian regarding the Fed's incompetency and the risk of these supply constraints evolving into a massive stagflationary crisis in the global economy.
How big of a wild card is the supply chain issue and supply constraint issue as you think about the last quarter of the year?
Huge, absolutely huge, because they are so persistent and they're cascading. So this is no longer just about supply chains, as disrupted as they are. This is about transportation, about containers, about port congestion, both at the port of origin and at the port of destination. And it's about persistent labor market shortage. So it's a big issue that we haven't gotten our arms around it yet. I think companies are much more advanced than policymakers and market participants are about this.
Meaning their view of inflation is more prolonged than just transitory? I mean, I'm curious because, the underpinning to the transitory argument had been that anything arising from supply chain disruptions would be short-lived. And yet we have companies coming out, on their earnings call saying it's going to last much longer than they had thought, maybe even stretching into early next year.
Yeah, and that's something that I've been concerned about for a while, that people got so focus on base effects and other imbalances that they didn't realize what really was going on the supply side. Yes, it is going to be longer. It's going to be longer both for materials and for labor. And that is not an issue that's factored in. The Fed still believes it's transitory. And unless it extends transitory to include 2 years, this is not going to prove transitory.
And the last story of the day is the flash crash in the crypto market. And it comes on the day where the country of El Salvador, have adapted Bitcoin as an official currency. The president of the country has been pumping and prompting the official day of the adoption of Bitcoin as a legal tender in El Salvador. And it was dubbed as Bitcoin Day. You have to buy $30 of BTC to support the movement. And what happened is, El Salvador bought about $21 million worth of Bitcoin, and fast forward, the very next day, the so-called Bitcoin Day, cryptos crashed across the board, and this raises a lot of concerns. This is a tulip market with no fundamentals at all, and now we have a country that is already suffering from poverty and corruption adapting a tulip as a currency. What could go wrong, right? And this guy is already embattled in his own country politically. Between the corruption, the authoritarianism, the ties to the gang, MS-13, and who knows what else. So perhaps this was a pump and dump scheme for the president of El Salvador to enrich himself personally. Who knows what his personal stake is in Bitcoin, and now he's using the country's money to pump cryptos higher. And he failed anyways. Now in a country ruled by gangs, the likes of MS-13 for example, now this guy put the entire country's neck on the line, meaning let's say these gangsters invest in cryptos based on him. What will happen to this guy when gangsters start to lose money? My prediction is this guy will not last at all. This guy will end up being assassinated sooner or later. But perhaps this is a good time to talk about the tulip market and the illusion that the crypto maniacs have been touting in the global market, that this is a reliable investment vehicle, that Bitcoin will be adaptable in the future, that cryptos serve a purpose and a legitimate utility, when we know that all of this is garbage. It's a tulip market with no intrinsic value at all. It's a tradable asset based on the psychology, and that's about it. Perhaps it's a bad sign, a market top sign, when you have Kim Kardashian pumping cryptos and every celebrity, athlete, model, porn star now touting, promoting, and pumping their own cryptos. Perhaps it's time to go out when you have every athlete, for example, Naomi Osaka, now have interest in cryptocurrencies. We have douchebag, dirtbag, perhaps the biggest asshole in the Milky Way, Tom Brady, also pumping cryptos with the laser beams and all of that stupidity. And we all know that Tom Brady is a cheat, a scam artist, and a scumbag. For example, he scored millions of dollars in PPP loans. Oh, poor Tom Brady. He needs help, right? Meanwhile, Tom Brady and his wife Gisele Bündchen, their combined net worth is over $650 million. And you look at some of Tom Brady's mansions, they can house the entire country of Afghanistan. And now, of course, we have another scam from Tom Brady pumping cryptos online. We also have Steven Seagal being used to scam crypto investors. And we know that even the platform of trading cryptos, Coinbase, customers are being hacked, they're losing their money, and there is no customer support at all. This is the ecosystem of the tulip market. So you have a tulip with no intrinsic value at all, beside the psychology, and somebody else next to you willing to pay more for it. We have no utility at all in cryptos. We have scumbags, athletes, celebrities pumping cryptos across the board. Porn stars, Mia Khalifa pumping cryptos and Doge. But if that wasn't enough for you to realize that this is all garbage, and it will come down crashing on your head in the worst fashion. What about this? Bitcoin mining consumes 0.5 percentage point of all electricity used globally and 7 times Google's total usage, new report says. So on top of all of that, it is also the worst thing for the environment ever right now. But is Mama Cathie Wood, for example, in her new transparency ETF, is she banning cryptos for polluting the environment? Of course not. Why? Because she's a scumbag who has a stake in the game, and she's pumping this to make money off you, not for you. Anyhow, folks, we spent a lot of time here and perhaps made a lot of enemies and a lot of whiny babies who are gonna cry in the comments, "You're wrong, bro. So let's move on to the market's coverage and see how the market closed today. And here we go. The Dow Industrial Average closed in the red, down 269.09 points, or a decline of 0.76%. The Nasdaq closed in the green slightly by 10.81 points, or a gain of 0.07%. The S&P 500 closing in the red, down 15.40 points, or a decline of 0.34%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, consumer cyclicals, and a number 2 for the silver, communication services, and we're not giving bronze here because the number 3 energy closing negative today. But leading the declines, industrials, utilities, and consumer defensives. No theme at all today. What about the advance to decline ratio? Here it is. The NYSE, 32% advancing versus 66% declining. The Nasdaq, 38% advancing versus 59% declining. Not a good breadth for the market here. Moving on to futures, red across the board. It's a massacre across the board. Why? The US dollar is surging higher, at least for today. And once again, this is an evidence to support the argument that the rise in yields today was not due to expectations of delayed tapering rather than the expectations of actual tapering. Once again, everything closing in the red with the exceptions of cocoa, cotton, OJ, and coffee closing in the green. We also have rough rice and grains closing at the flat line. But besides that, it's a massacre across the board. Now, you know where the massacre doesn't exist? How about the prices of fertilizers? Yes, there is a lot of money in shit because the prices of nitrogen and potash, for example, surging higher, leading fertilizers prices to ride higher. The only play that I have in my portfolio for fertilizers is the company Nutrien, the ticker NTR. And again, this is one of those stagflationary stocks where you have to go and get deep in the source. You invest in fertilizers, metals, you go down to the source, to the core, because the likelihood is the core can sustain a price advantage, even in a stagflationary environment, because when it comes to essentials, you cannot forego essentials. You have to consume them even in a stagflationary environment. So you're going to have to pay the prices, the extra prices, no escape at all. So once again, when we talk about the stagflationary portfolio, you have to look for the source, specifically essentials for consumers. We're talking about grocery stores, we're talking about food, we're talking about fertilizers, we're talking about metals. These are the kind of stocks that will outperform in a stagflationary environment. Moving on to the big casino, the options market. What's going on here? At number one, the hottest table per usual, Apple, with about 1.5 million contracts traded today. About 71.5% of those were calls. This is, of course, a trick, an old trick to rescue the market, to prevent the collapse. Keep pumping Apple via call options, and you can prevent severe damage from happening in the market. Why? Because Apple has the largest weighting in the S&P 500 and the NASDAQ. How about Tesla, number two, with about 735,000 contracts? About 58% of those were calls. And at number three, here comes a meme stock rising from the dead, CLOV, Clover Health, with about 660,000 contracts traded for the name today. About 85% of those were calls. And again, you see the per usual meme stocks, the likes of BBIG, which caught a bid midday, surging higher via call options. We have SPRT and KPLT. All of these meme stocks are still active in the options market. Moving on to the unusual trades that took place in the options market today. Speaking of the devil, here it is, BBIG. They're betting for more gains to come here by buying the $10 calls, expiration date September 10th. What does that mean? It means this upcoming Friday, and they are expecting gains of over 7% by the end of the week. They paid about $1.30 a piece to enter this trade. All in all, spending about $4 million. We have another trade for BBIG. A lot of them were calls, betting for the stock to rise higher by the end of the week. The majority of trades for this name were for the expiration date of this upcoming Friday, so you only got 3 days here for the stock to pop higher again. What about the trade for the ticker ARKK? We have two of those. We have a put and a call trade. We're going to go over the put one, but I'll show you the call trade for RKK. And it's interesting because you have the Michael Burry school of thought betting against RKK. In other words, a bet against deflation and for yields to rise higher. But we have competitors. We have another school of thought that says deflation will happen. The Fed will have no choice but resume quantitative easing and forgo tapering altogether because the economy will weaken, and therefore we will see deflation and a collapse in the 10-year yield, and therefore you have to buy stocks, growth, momentum, like the RKK. But here it is. This is the bearish trade. They bought the 116 puts with the expiration date of September 24th, with the expectations that the name will drop by over 7% by then, and they paid about $1.35 a piece to enter this trade. All in all, spending about $2 million. What about the trade for the ticker NUE, Nucor? This is interesting, by the way. They bought the 140 call, expiration date October 22nd, with expectations that the name will skyrocket higher by over 22% by then. They paid about $1.15 a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker QQQs, the NASDAQ? This is perhaps an insurance kind of trade for somebody who is overweight with the technology names, because they bought the 305 puts with the expiration date of November 19th, with expectations that the Qs will crash by over 20%. So we're talking about a bear market here. By November, according to this bet, they paid about $1.70 a piece, all in all paying about $1.7 million. What about the trade for the ticker IWM? They're making a bearish bet here by buying the 193 puts with the expiration date November 19th. Once again, betting against two different indices with the same expiration date and betting for them to crash. In this case, they bought the 193 puts, again November 19th, with the expectations that the IWM will crash by over 15% by then, and they paid about $2 a piece to enter this trade. All in all, spending about $1.5 million. Continuing with interesting trades, we have the ticker HIPO. for a company called Hippo. Now, this stock moved higher after YouTuber Meet Kevin pumped it. And of course, where's the SEC? Forget about them. They're in a coma. But what is the difference between a YouTuber pumping a stock and a Wall Street analyst issuing an upgrade out of the blue? The problem for Kevin Pafarath, or whatever the hell his name is, if he dumps and if he books profits, for example, he bought the stock and after the pump he cashes in, or he bought call options and after the pump he closes the trade. The guy will be in handcuffs, not heading to become the governor of California. But regardless, they're betting for more gains to come for Hippo. They bought the 7.5 calls with the expiration date of October 15th, with the expectations that the name will rise higher by over 20% by then. They paid about 60 cents a piece to enter this trade. All in all, spending about $300,000. Here's the RKK trade that I talked about before. And then we have few interesting ones for mRNA Moderna, and both bets for the expiration date of this upcoming Friday. So there are expectations and rumors that the FDA will announce something about Moderna, whether approving the booster shot or denying the booster shot from Moderna, because Moderna will have a case against the FDA that the FDA favored Pfizer against Moderna in the booster shots. So we'll see what happens, but I'm reading the biggest bet here, which is for the upside, the call trade. They bought the 460 calls with the expiration date of September 10th, meaning this upcoming Friday, with expectations that Moderna will rise higher by over 5% by then. They paid about $4 a piece to enter this trade. All in all, spending about $1.5 million. Lastly, what about the trade for the ticker UPST? For Upstart, they're making a bearish bet here by buying the 250 puts, the expiration date of this upcoming Friday, September 10th, with the expectations that the name will drop by over 6% by then. And they paid about $3 a piece to enter this trade. All in all, spending about $1.3 million. Moving on to the heat map analysis. What's going on here? Again, themeless, and the market all in all trading to the downside. Some financials managed to outperform due to the rise in yields, but all in all, the inflation trade got absolutely whacked today. Industrials, energy, materials, financials, all in all trading to the downside, even though yields are trading higher. Number one, the dollar is trading higher, and this will dent the inflation trade for sure. But then we have weakness in software and chips, likewise the defensives, utilities, real estate, all trading down. What's working? The Chinese names, and of course, with the Chinese names, now we have casinos. We have some news that Macau is renewing licenses for Wynn, etc. But as of late, recently, Las Vegas Sands and Wynn Resorts have been trading hand in hand with the Chinese names. As Chinese stocks crashed, these names also crashed. And as Chinese names recovered, they also recovered. Why? Because they're China play. Wynn and Las Vegas Sands pretty much purely a Macau play. Yet casino and gambling stocks in general outperformed today. Not just Wynn and Las Vegas Sands, but also MGM, and we have DraftKings also rising higher today by over 4%. And the reason is we have the football season, and the expectations are that this will be the hottest sports gambling season ever. And I don't doubt that because, after all, we are a degenerate gambling nation. We talked about Apple and Tesla being pumped artificially higher. And then we have Netflix, which I talked about last night. We have the institutionals buying Netflix. The note was passed to me about 2 weeks ago. Buy Netflix because the institutionals are buying. But again, to me, it's too late to buy anything right now because we're getting closer and closer to a correction in the market, perhaps a severe one. So you can trade, you can buy call options, but opening new positions seems a little irresponsible for me at this point of the game. Moving on to the charts analysis, and we will start with the tweet that I issued today regarding the SPY. And this is a 15 minutes chart, by the way. And it appeared to be a bear flag formation. And indeed, the bear flag played out and we saw losses from a 15 minutes perspective. But I'm switching to my 30 minutes chart because the sustainability of the losses are not guaranteed here. The dip could be bought. We could see the SPY trading higher tomorrow. What I'm looking at right now is violating the lows of the day, which coincide, by the way, with the previous gap. If that level is violated, then the chart will flush down all the way to 447, which happens to be the next support. Now, there is a gap above that was open in the morning, and if the SPY decides to trade higher, the gap will be looked at as a target. So we have to look at the gaps above and below and how the chart reacts to each gap. And these gaps will be the support and resistance for the chart right now. Moving on to the daily chart of the continuous contract on the SPY, we're starting to see some weakness here and a topping formation in the momentum indicators, the RSI and the MACD indicators. Now, the divergence from the trend line is normal, and therefore if the SPY starts to pull down from this point, it's a garden variety correction, not a last hurrah rally. What about the Qs? 30 minutes chart, the Qs fared a little better than the SPY and the Dow, but again trading within range, nothing new at all. Now, you know that the advance to decline ratio for the Nasdaq was bad today, meaning that the majority of names were trading in the red. But the outperformance of Apple, Amazon, Tesla all acted as a solid floor to prevent the Nasdaq from selling off. This is a daily chart for the continuous contract for the Nasdaq. Once again, yes, toppy formations, toppy levels, not formations, but levels for the RSI and the MACD indicators. Now, unlike the SPY, we're not seeing any topping formations here, where the momentum indicators are curling down, for example. They're still trading strong, and the candlestick pattern remains a bull flag formation. But how long will these market makers be able to keep the Nasdaq afloat when we have yields popping higher, assuming that they will continue to pop higher? Here's a 30 minutes chart for the IWM. We talked about 229 as the resistance level. The chart peaked above that level for a little while before going down, gathering energy to pop higher. That attempt to pop higher was met with rejection, and the chart failed to gather the energy and break above 229. What does that mean? It means it has to go a little down, a little lower, perhaps all the way down to 223, the support, to gather the energy to pop higher again. Every chart acts the same way when facing resistance. There is an attempt, and if the attempt is met with rejection, then the chart goes down to prior support levels to gather the energy needed to pop higher above the resistance level once and for all. Moving on to the Dixie, the dollar index, and this is the most important chart for the day, for the week, until we get clarity regarding tapering. But the market will not wait until tapering to take action. And again, if the dollar index continues to pop higher, then this is an indicator that the market is indeed believing the tapering narrative. The tapering will happen for sure. Not a joke this time around. And we have the double bottom at 92. The reality is, after a massive pop, just like we got today, this creates a dip in other currencies. The likes of the Australian dollar, sterling, the Kiwi all go down. And these dips will be bought overnight by overseas traders. So the Dixie could dip overnight, but for me, the reaction as the US market starts to trade is the most important reaction. Will the Dixie continue to build on gains, believing the tapering narrative for real this time around, or was the reaction we got today a transitory reaction? Let's say the aftermath of the Labor Day holiday, perhaps we have Rosh Hashanah going on, and we will see a different reaction throughout the week. We will see. But the dollar index rising higher will not be good for commodities and the inflationary stocks. Speaking of, here it is, gold. What a flush down. It stopped and reversed right on the penny at the Fibonacci retracement level of around 1,830. So if you are a gold trader, you should have taken profits right away. You bought the dip, you made a killing. Now is the time to book profits. Look at what happened to gold today, and look at what happened to cryptos. Greed is not good. When you make 70%, 80% gains in a few weeks, you gotta book those profits. And again, gold has two enemies, the dollar and yields. When both rise together, forget about gold. Gold is dead. Goodbye. Here it is, the 10-year yield, the second most important chart in the market right now. Surging higher. We talked about the cup and handle, within the cup and handle, within the cup and handle. We're about to go to the resistance zone around 1.4. 1.4 will be tough to crack, but not impossible. It will perhaps take a few days before yields pop higher and close above 1.4. As we get to 1.4, 1.45, and yields hit 1.5, once again, the market will start to panic. And perhaps the only performer will be financials. So pay attention here and be prepared. The TLT weekly chart not looking good here. It looks like a topping formation. From a MACD and RSI perspective, perhaps the run in this leg is over. And it's time for the TLT to catch a break, and then we'll see what happens later on. The bond market in general will be extremely sensitive to the tapering outlook and the slew of economic data. The VIX, what's going on here? We talked about the pop in the VIX from a 4 hours perspective in the MACD indicator. Perhaps this is the leading indicator. The SPY has more losses to come because looking at the MACD indicator, it doesn't appear that this pop is over yet. It appears that there are more gains to come in this pop. Perhaps another shot all the way to 20. And if that happens, we have more losses for the SPY. But you gotta watch the MACD indicator from a 4 hours perspective in the VIX. This will be a leading indicator whether the SPY will continue to go down or whether the dips will be bought. Apple 30 minutes chart, we already talked about this one. Nothing to see here. A pump via call options, and so long as Apple is trading above 150, no problem at all. This is my leading indicator, but it's being corrupted as we speak due to the funny activities in the options market. It's a bull flag formation indicating more gains to come. But as we have seen in the past, the pumps on Mondays and Tuesdays don't last at all. But for me, so long as Apple is trading above 150, then the market is still okay. And of course, the smarty pants will put the pieces of the puzzle all together. Looking at the VIX, the 4 hours, looking at the support lines for the SPY, looking at Apple and how it behaves around 150, watching the Dixie, watching yields around 1.4%. You piece all the pieces of the puzzle together and you will know exactly when the market is going to crack. Whether it's going to crack or not, you will be ahead of the game if you know how to use everything I'm teaching you right now and you combine it all together, you will be fine in timing the market. Tesla, the souffle, 30 minutes chart. What's going on here? Nothing at all. The candlestick pattern is a bull flag formation. Again, we have seen the pumps on Mondays and Tuesdays via call options. They pump, they dump, but so long as the chart is trading above 720 and making higher highs and higher lows, then the bull trend remains intact in the name. BTC, the massacre. What's going on here? A massive down day. My number was 53,200. The chart stopped pretty much at 53,000 and the massacre started. Now you know that the support will be 42,000. And if the chart doesn't go and retouch 42,000, then it's a dead cat bounce. You have to go down to 42,000 and then bounce higher. And that will give me assurance that at least the bounce is sustainable and we have legitimate dip buying. But this one, who knows, perhaps the guy in El Salvador, and he decided to use the country's money to buy more Bitcoin and buy the dip and hodl. This is a recipe for disaster. I say get the hell out of this tulip market because we have more disasters to happen here. This move by El Salvador is absolutely disastrous. And then we have ETH, Ethereum, which led the rally in the crypto market and now leading the losses and the crash. It was a massive reversal here for ETH, and we talked about this last night. The chart will eye all-time highs as a target, but the chart will reverse before reaching the target. And of course, the chart topped at, surprise, surprise, the round number 4,000. And the main question is this the top or not the top in the crypto market? My hunch is the dips will be bought from the crypto tulip faithful, but the involvement of the country of El Salvador in the crypto market is problematic to say the least, because the institutional investors will think twice now that the El Salvador is involved in the trade. This is not a clean administration, by the way. This is a corrupt administration, and they're going to be engaged in funny business to prop up the prices of Bitcoin. So the institutionals who bought Bitcoin will be also tied to the current ruling government of El Salvador. Lastly, what about AMC? This is a 45 minutes chart. We have identified 42.5 as support, and it has been tested over and over and over and over again. So from the get-go, heading into the week, we knew ahead of time that this support is solid and AMC has the permission to rally. But besides the technicals, we got some fundamentals, believe it or not. Now we know that AMC and meme stocks are not trading based on fundamentals. They're trading based on the momentum and the psychology. But we have news, fundamental news, from a release called Shang-Chi, whatever that is. And apparently it's a box office hit. AMC attendance surpasses 2019 levels for the first time during pandemic, thanks to Marvel's Chang-Chi. Now, when it comes to meme stocks, but AMC in particular, good news is good news. The apes and the likes will take good news, but bad news don't matter. We don't care about bad news. We did not get into this one because of the fundamentals. The apes and the likes, the zombies that they are, they got into this for the holy short squeeze. When is that going to happen? Who knows? But they continue to hodl, whatever it is, until that happens. What will it take to break AMC and we see the crash in AMC? It will be technical and it will be psychological. The technical part is breaking 32 as support. The psychological will be some of the biggest pumpers of AMC cashing in profits, abandoning the trade, and we will see profit taking snowballing into a domino effect of selling. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have jobs openings, and this is important because if jobs openings continue to rise higher, but hiring is not happening, we got the BLS jobs report, and we talked about that in details. If that is the case, then stagflation is here. The jobs are available, but they're not being filled. The expiration of unemployment benefits will have an impact in filling some of these jobs, but if we continue to see shortage and jobs openings rising higher and higher and higher, then we have more evidence for stagflation, which will lead to wages rising even higher. We also have the beige book from the Fed. In it, the Fed will outlay their outlook regarding the economy. And this will be an interesting one because the New York Fed pretty much abandoned forecasting GDP from this point on due to uncertainty. And we also have the Atlanta Fed revising their GDP forecast from over 5% all the way down to 3.5%, a major downgrade. So again, prices continue to surge higher. Meanwhile, GDP forecasts continue to go down. What is that? It's stagflation. It's already here, folks. Anyhow, this is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.